Welcome back to the deep dive. Right now, the financial world is, well, pretty fixated on Washington, D.C., and unfortunately, the news isn't great. The U.S. government has officially entered its second week of a shutdown because, yet again, Congress couldn't manage to pass the necessary funding bills, to keep the lights on, keep the staff paid. Now, if you follow traditional finance, you already know this is disruptive. Big time. But we are here today to really unpack this stack of sources we've got. They demonstrate how this political paralysis, this gridlock, immediately impacts the critical plumbing, the oversight, and, yeah, most importantly, the sentiment around the crypto markets. Look, this is far more than just some localized DC political fight for anyone holding decentralized assets. This is, well, it's a massive financial uncertainty event. You need to pay attention. So our mission today, it's custom tailored for you, really, to cut through all the noise and help you understand the tangible, the immediate effects of this instability on crypto. We're going to be focusing pretty intensely on this fascinating tension that always seems to arise. The market chaos created by instability versus the stability that's actually required for serious institutional capital growth.
And we absolutely have to start with the concrete facts, the operational facts on the ground. Because the government machinery that regulates, oversees, and, frankly, analyzes crypto isn't just slowing down. It's largely frozen.
Frozen? Wow. So which departments are we talking about?
Well, the essential ones, the ones that really govern digital assets, are severely affected. Think about the SEC, the Securities and Exchange Commission, right? They dictate market structure. Then there's the CFTC, the Commodity Futures Trading Commission, handling derivatives, and of course the Treasury Department, central to sanctions, compliance, all of them. They're running on what are essentially skeleton crews, bare minimum.
Okay, skeleton crews at the regulators, that's already bad.
But it gets worse. What's really fascinating here, or maybe worrying, is that we also have this parallel data freeze. And that just exacerbates the market risk. Agencies like the Bureau of Labor Statistics, the BLS, they generate those critical inflation metrics, CPI, PPI, the really important jobs reports. They're paused too. Without that input, the market becomes blind.
Wow, that's a powerful combination, isn't it? A double whammy. Because you've got this dual uncertainty hitting at the same time. You lose regulatory clarity because the watchdogs are basically on mandatory leave. And simultaneously, you lose your macro forecasting ability because the fundamental economic data, that spigot's just been turned off.
Precisely. And in a high-risk asset class like crypto, where, let's be honest, sentiment and momentum are pretty much everything, this translates immediately into volatility. If you can't price risk accurately, what do? You either stop trading altogether or you demand a much higher premium for the trades you do make.
Okay, let's unpack the regulatory side first then. We're calling this Section 1, the regulatory stall and its direct impact on investment flow. Makes sense. So the core argument, looking through all our sources, it seems pretty straightforward. With regulators offline or, severely understaffed, enforcement actions slow right down, and maybe more crucially, those approval processes, the gatekeepers for the next big wave of institutional investment, they're stalling out completely.
Yeah, stalling or stop debt.
Think about the biggest things the crypto industry is waiting on right now, those really high-profile regulatory decisions. We're talking about the potential approval of spot Ethereum ETFs, right?
Yeah.
Or maybe finalizing new exchange registrations, complex custody rule changes, stuff like that.
And these are not simple yes or no things, not at all. They require dedicated staff, people who need to review literally thousands of pages of filings, hold meetings, provide detailed legal feedback. It's complex work.
Right. And you can't do that with a skeleton crew.
Exactly. When only a handful of essential staff are working, and their primary job is probably just keeping the basic systems running or handling cybersecurity, those really complex review processes, they just stop, period. You cannot rely on a few essential people to review, say, a multi-billion-dollar ETF application. So this doesn't just slow down innovation. It effectively slams the brakes on that whole legitimization process that, frankly, Wall Street craves.
Slams the brakes. But you mentioned something interesting there, a dichotomy.
Yeah, there's kind of an interesting split here. While the largest, most legitimate institutional players, they're screaming for clarity, right? They need those rules. But some segments of the crypto industry might actually, maybe secretly, enjoy a temporary reprieve from this.
How so?
Well, think about it. A slowdown in the filing of new crypto prosecutions or maybe enforcement actions against certain exchanges that might be under scrutiny, it gives them some temporary breathing room, less heat from the regulators for a bit.
Okay. I see that. It temporarily lowers the regulatory temperature for maybe some smaller or, let's say, less compliant players. But you made a crucial point earlier about the institutional headache this creates. Let's go back to that. How specifically does this lack of clarity deter those massive pools of capital we keep hearing are waiting to enter the space?
Yeah, this is key. It really comes down to fiduciary duty and compliance. Plain and simple. Big institutions, we're talking pension funds, traditional asset managers, large family offices, they don't invest based on hope or, pure speculation. Not with other people's money. They invest through specific, highly regulated channels. They absolutely require clear, defined rules of the road before they can deploy serious capital.
So if the SEC isn't fully functional.
Right. If the SEC can't provide clear guidance on something fundamental like custody, or if the timeline for approving a major product like an ETF is now just indefinite, it creates an insurmountable compliance hurdle. Think about it. A fund manager literally cannot tell their investors, yeah, we'll deploy that $500 million, whenever the government decides to open back up.
Yeah, that wouldn't fly.
Not a chance.
Yeah.
That level of ambiguity is just an unacceptable risk for institutions. It freezes their decision-making.
So, okay, we have this fundamental contradiction playing out right now. It's really fascinating. On the one hand, this political instability, this government shutdown, it kind of validates the whole reason for decentralized systems to exist, right? It highlights the failure of the centralized state. And like you said, the immediate pause in enforcement might temporarily satisfy those who always rail against government interference.
Absolutely. That's the short-term, almost knee-jerk reaction for some. But, and this is the crucial but, if we connect this to the bigger picture, that overall institutional adoption, the thing that's really necessary to push crypto market cap into the multi-trillions, that adoption is fundamentally dependent on stability and clear rules to flourish. It just is. So the very short-term chaos that might excite the crypto maximalists simultaneously suffocates the long-term institutional growth everyone ultimately hopes for.
Wow. That tension is absolutely central to understanding the market dynamics right now. You've really got to hold both ideas in your head. Which brings us perfectly into Section 2, historical context in crypto's volatility paradox. Let's start with traditional markets. How do they usually handle this kind of political drama?
Yeah, traditional markets are generally pretty predictable during a shutdown, historically speaking. It causes a short-term jolt, right?
Yeah.
The S&P 500 might dip maybe 0.5%, maybe 1.5% in the first few days. A bit of nervousness. But markets tend to price it pretty quickly as just a temporary political hiccup. The assumption is always that Congress will eventually compromise and get things funded.
So the rebound is usually pretty swift.
Usually, yeah. Once the funding gap is resolved, things tend to snap back fairly quickly in traditional finance.
Okay. But here's where it gets really interesting for crypto, because as you hinted, it doesn't seem to follow that predictable script at all. Our sources are showing a pretty clear pattern. Crypto's volatility doesn't just move with the S&P during these times. It often spikes, specifically during periods of acute U.S. political or, crucially, fiscal instability.
That's right. It behaves differently.
So why? Why does this happen? What's the thinking?
Well, the thinking is that savvy traders, and maybe even longer-term investors, use these specific moments, these moments of government dysfunction, to actively seek hedges. Hedges against the perceived weakness in the traditional market structure, and specifically weakness tied to the U.S. government itself. They view U.S. fiscal instability like a failure to pass a budget, a failure to pay bills, as a really strong cue to move capital into non-sovereign digital assets.
So it's the ultimate validation of that whole anti-establishment thesis that crypto was kind of built on.
Exactly. It plays right into that core narrative. When the existing system looks shaky, the alternative system looks more attractive.
And does the historical data actually back this up?
Yeah, the analysis backs this up pretty strongly.
There.
We can look at the two most significant recent shutdowns.
Yeah.
The one in 2018 and then that much longer one in 2019. During those specific periods, Bitcoin's correlation with traditional safe haven assets, think physical gold, maybe even some government bonds, it measurably increased. Investors were actively, demonstrably treating Bitcoin less like a risky tech stock and more like, well, digital gold.
Okay, let's dive deeper into that 2019 one. That was the longest ever, right? 35 days.
That's the one.
Yeah.
A brutal 35 days. And that event had profound impacts across the board. We saw delayed SEC filings, not just for crypto, but for traditional IPOs too. Government services ground to a halt. General macroeconomic uncertainty just intensified day by day.
I remember that time vividly. It felt like things were really creaking. So what was Bitcoin doing while Washington was completely gridlocked?
Well, this is the interesting part. Bitcoin demonstrated pretty striking resilience. It held steady, mostly around the $3,500 to $4,000 range.
Okay, so it didn't necessarily rocket up instantly.
No, not instantly. But critically, it maintained that floor, it found support, while these serious macro concerns about the U.S. system itself were intensifying all around it. And maybe more importantly, market analysts at the time observed capital specifically fleeing other high-risk assets and actually flowing into BTC. It showed a clear preference among some investors for the decentralized hedge over traditional risk-on plays during that specific crisis.
That is a powerful demonstration of this volatility paradox you mentioned.
It really is. And the investor takeaway here is complex, it's not simple. Traders have to navigate this reality that, yes, crypto seems to thrive in chaos, fueled by that anti-establishment thesis. But that same chaos, specifically the regulatory instability caused by this shutdown, simultaneously suffocates the institutional adoption that's needed for long-term price stability and growth.
So traders and funds, right now, they have to perform this really complex calculation. It's like weighing two opposing forces. Does the short-term regulatory risk, caused by the SEC being basically offline, does that outweigh the potential long-term benefit of using Bitcoin as a systemic hedge against a state system that just keeps demonstrating this chronic dysfunction?
That's the million-dollar question, isn't it? Or maybe the multi-billion-dollar question for the big funds.
That inherent conflict leads us perfectly into Section 3. Balancing short-term uncertainty against the long-term erosion of confidence. Let's look at the immediate tactical market response first, the noise.
Yeah, the short-term view is often just noise, mostly driven by low liquidity, maybe some panic. When the government freezes up like this, some investors, particularly retail traders, maybe highly leveraged entities, they instinctively just flee all risk, not just U.S.-specific risk, just risk off. And this is what creates those short-lived, sometimes sharp reactionary sell-offs across major tokens. That's the emotional noise you typically see in the first few days of any crisis like this.
Okay, so that's the market's immediate stress test, the knee-jerk reaction. But what happens if this shutdown really drags on? If it's not just a few days, but weeks? What happens to the bigger macro picture then?
Well, that's when the long-term picture starts to become far more profound. And it's where the macro headwinds and, interestingly, the tailwinds begin to diverge quite powerfully.
Okay, let's start with the negative side first. The headwinds. You mentioned delayed Fed policy.
Exactly. This is a potential negative headwind. As we mentioned earlier, those key economic data points, the BLS numbers for inflation, employment, wages, they're paused. The reports aren't coming out. Now, if the Federal Reserve loses visibility into the real-time health of the U.S. economy, they lose confidence in their policy decisions. They're essentially flying blind.
Okay, what's the mechanism there? If they can't get confirmation that inflation is cooling or maybe that the job market is softening like they want it to, what are the implications for interest rates?
It creates hesitation, caution. The Fed relies heavily on those precise data points to time their interest rate decisions, hikes, pauses, cuts. If they don't have clear, reliable data, they are far more likely to maintain a cautious, maybe even restrictive stance for longer, just to be safe. This could easily lead to delayed interest rate cuts, pushing them further into the future than the market might currently be anticipating.
And delayed rate cuts means?
It means longer periods of expensive capital, higher borrowing costs, and that's a classic negative signal for high-risk, growth-oriented assets, which includes most altcoins and even leveraged Bitcoin positions. So that's a clear potential negative.
Got it. Okay, so that's the potential headwind from delayed Fed policy. But you mentioned a countervailing force, a tailwind.
Yes, and this is potentially a massive countervailing force. This is where the digital gold thesis really kicks into high gear. We're talking about the weakening dollar narrative.
The dollar. Okay.
Absolutely. Look, a prolonged shutdown, especially if it starts to merge into concerns about U.S. debt repayment down the line or just general governance, it fundamentally and very visibly erodes confidence in the U.S. dollar, and maybe more broadly, in U.S. fiscal management overall. You have to remember the dollar is still the bedrock of the global economy. Its most important feature isn't just its value, it's its reliability, its stability.
And these shutdowns make it look unreliable.
Exactly. Every single time Washington forces a funding crisis like this, or worse, flirts with the debt ceiling, global counterparties take note. We're talking sovereign nations holding U.S. treasuries, major international corporations, global investors. They see a failure to govern. And that translates directly into a perception of increased solvency risk, or at the very minimum, just extreme political volatility tied to the world's reserve currency. That's not good.
So when confidence in that centralized foundation, the U.S. government, the dollar starts to falter, investors both here and globally, they instinctively start looking for alternatives that are, well, non-sovereign, outside that system.
Precisely. This erosion of confidence is highly beneficial for the whole digital gold argument for Bitcoin. The idea that it's a mathematically defined, apolitical store of value, independent of any government's whims. We saw this play out incredibly vividly just last year during the 2023 debt ceiling crisis, which arguably was a much more serious fiscal event than a simple shutdown. That was about potential default.
Oh, yeah, we absolutely must recall that moment. The 2023 debt ceiling crisis. It briefly threatened actual U.S. default and Bitcoin. It pushed from around $26,000 all the way up to $31,000 in a remarkably short period.
That surge wasn't just random market noise. That was a massive capital flight into a non-sovereign hedge. You could see it in the flows. Investors, genuinely worried about the potential devaluation of the dollar or the stability of U.S. treasuries if a deal wasn't reached, moved significant capital into BTC. Why? Purely based on the desire for an alternative to dollar exposure. The market was essentially signaling that mathematical scarcity felt safer than political promises at that moment.
Wow. So the core thesis gets reaffirmed every single time this happens.
It really does. This current shutdown just serves as another powerful, real-world confirmation of crypto's original anti-establishment thesis. When centralized governments, which are ultimately built on fragile political consensus, fail to function effectively, decentralized systems, built on stable, predictable code, just look increasingly attractive as reliable hedges against that very instability.
Okay, moving into Section 4 then. Let's broaden the lens and discuss the political, economic, and even global ripples of this event. Because the fallout clearly goes far beyond just the immediate crypto charts, starting with the domestic fallout. It feels crucial to understand that this current congressional standoff, this shutdown, it's probably not just an isolated incident, is it? Our sources seem to suggest that this gridlock might simply be foreshadowing greater, maybe even more complex risks down the line.
That's a very real concern. I mean, let's say Congress manages to pass a temporary funding measure, a continuing resolution or CR, just to kick the can down the road for a few weeks or months. Okay, crisis averted short term. But if they then fail to pass a full-year budget later on, the deep political fissures, the reasons they couldn't agree in the first place, they remain. We could just be perpetually running the risk of the debt ceiling tension reigniting, perhaps early next year, and that would be an even more severe crisis, multiplying the instability we're seeing right now. It feels like a recurring pattern.
Yeah, it does feel like Groundhog Day sometimes. And meanwhile, we cannot ignore the tangible human and economic cost of the shutdown itself right now. Our sources are citing estimates pretty consistently that over 800,000 federal government workers are missing paychecks, or will be soon.
That's a huge number.
It is. And this isn't just an abstract number on a page. These are real people, real consumers who immediately stop or drastically cut back on discretionary spending. Mortgages, food, gas. Essential spending might continue, but everything else gets slashed.
And that has immediate ripple effects through the economy.
Exactly. Think about it. Reduced consumer spending instantly hits local businesses, restaurants, shops, services. That impacts corporate earnings down the line, which then ripples through the traditional stock markets. And ultimately, it lowers GDP growth expectations for the quarter, maybe even the year.
And that feeds back into general market uncertainty.
Which, again, strengthens the long-term case for those non-sovereign hedges we were just talking about. It's a cycle.
Absolutely. If the U.S. domestic economy shows signs of deepening weakness, partly because of these repeated chronic political failures, the narrative for Bitcoin as a long-term hedge doesn't just hold steady. It actually strengthens quite dramatically. And this potential scenario, of maybe constrained supply post-halving meeting, heightened fiscal awareness and instability, that becomes particularly potent when we look ahead to the next cycle, especially thinking about 2025 and the halving cycle.
Okay, now let's connect this domestic instability to the bigger global picture, the geopolitical fallout. You mentioned earlier this presents a significant opportunity for global competitors, that the U.S. stalling creates a kind of geopolitical opening. Can you expand on that?
Yeah, think about the U.S. role. It's supposed to be the financial and regulatory leader for certainly the Western world, setting the norms and standards, including for new things like digital assets. But when Washington is completely inwardly focused, distracted by its own budget battles, and effectively shut down in key areas, it basically hands global competitors a clear window, a chance to accelerate their own digital initiatives without worrying about immediate U.S. pushback or strong influence on the direction things take.
So what kind of actions or advancements are we talking about? Who benefits?
Well, consider the competition. Look at the European Union. They're moving really rapidly now toward implementing MiCA, that's the Markets and Crypto Assets Regulation. MiCA aims to create a single, cohesive regulatory framework for crypto across the entire bloc. That's huge progress towards clarity. Meanwhile, you've got China continuing its advanced testing and rollout of the digital yuan, their CBDC. So while the SEC is literally sending essential personnel home, the EU is making major strides toward regulatory clarity and creating standardized digital asset markets. China's pushing its digital currency. The U.S. looks stalled.
So the U.S. risks falling further behind, not just technologically maybe, but in actually establishing the necessary global regulatory structure that would, ironically, probably protect its own long-term interests and the dominance of the dollar system.
Precisely. The U.S. is paralyzed, or at least appears paralyzed, and that reinforces this image internationally of an unreliable partner and internally fractured global power. And this, critically, feeds directly into that whole de-dollarization movement that we've been tracking for a while now.
Ah, right. The BRICS nations and others looking to trade outside the dollar system.
Exactly. A prolonged shutdown, or even just the repeated threat of shutdowns and debt ceiling crises, absolutely accelerates the efforts by major global economies, especially the BRICS nations. Brazil, Russia, India, China, South Africa, and now others joining. It accelerates their efforts to reduce their reliance on the U.S. dollar, both for international trade settlement and as a primary reserve currency.
Why? Just because it signals unreliability.
Pretty much. It signals unreliable fiscal management, political instability, right at the heart of the world's reserve currency provider. If you're another country, you start thinking, maybe we need a plan B or C.
So it's kind of an involuntary push away from the dollar caused by the U.S. itself.
You could definitely see it that way. And this instability, this push, indirectly benefits crypto and potentially other non-sovereign digital payment systems. If global traders, corporations, even governments are actively looking for reliable, stable alternatives to dollar hegemony, well, decentralized assets built on math and code, they start to look like increasingly appealing candidates over the long run. So yeah, this event, this shutdown, it's another powerful long-term catalyst potentially fueling that gradual transition away from dollar dominance.
That is a fascinating and, frankly, crucial macro thesis to understand. Okay, let's bring it back home. Let's make this really actionable for listeners. If we accept this macro perspective that U.S. instability, however messy short-term, is actually a long-term bullish signal for decentralized assets, what concrete specific signals should smart investors and traders be tracking right now during this shutdown? This is Section 5. Monitoring the signals, what should you be watching?
Right. This is where we transition from the big macro theory to, practical, actionable metrics. We need to track capital movement obsessively right now. Where is the money actually flowing? Is it flowing into perceived digital safety, like Bitcoin? Is it fleeing all risk, maybe moving into cash or fiat? Or is it staying on the sidelines, but within the crypto ecosystem, maybe in stablecoins, ready to deploy again? Those are the key questions.
Okay, first metric.
First, you absolutely have to monitor Bitcoin dominance. The metric that tracks Bitcoin's market capitalization relative to the total market cap of the entire crypto space. During a typical flight to quality within crypto, investors tend to consolidate their risk. They move out of more speculative altcoins and into the most liquid, most established asset, which is Bitcoin.
So what's the specific signal we're looking for in Bitcoin dominance? A rise, a fall?
We want to see if Bitcoin dominance is rising meaningfully during the shutdown. Let's say it climbs above, 50% or moves up a couple of percentage points pretty rapidly. That signals that investors are prioritizing BTC. They're moving into that digital safety mode. It suggests maybe more institutional or at least more risk-averse positioning rather than just pure speculation. Now, if dominance falls significantly, that might suggest a broader market sell-off where even BTC is being dumped, probably for fiat. That's a more bearish signal.
Okay, track Bitcoin dominance. What about institutional health? Given all that regulatory fog we talked about in Section 1, how can we even measure institutional confidence if they're technically supposed to be sitting on the sidelines because of the uncertainty?
Yeah, it's tricky, but there are proxies. We need to monitor ETH performance, especially relative to Bitcoin, and also look closely at DeFi TVL total value, locked-in decentralized finance protocols. Why ETH and DeFi? Well, Ethereum is often viewed as the primary institutional gateway into that whole decentralized finance ecosystem, partly because of its robust ecosystem, partly because of the progress, however stalled now, on spot ETH ETFs.
Right. So what does ETH price or DeFi TVL tell us?
Well, a noticeable slowdown in ETH's price performance compared to Bitcoin, or maybe more crucially, a stagnation, or even a decrease in DeFi TVL. That would indicate decreased institutional confidence or activity. Institutions use DeFi for things like lending, borrowing, staking, maybe some structured products. If that money isn't flowing into DeFi protocols or if it's being withdrawn, it strongly suggests that the regulatory fog, the fear that compliance rules could suddenly change when the SEC eventually reopens fully, is keeping the big money out of those decentralized applications for now.
That's a really critical differentiation. TVL tells us what capital is actually doing inside the crypto ecosystem, not just what the headline price is.
Exactly. It's about activity. Now, another absolutely crucial set of indicators, maybe one of the most important right now, are stablecoin flows. You absolutely need to track the movements of the major stablecoins, primarily Tether, USDT, and USDC. Remember, these coins represent the US dollar, essentially, but they live on exchanges and in decentralized wallets.
And their movement tells us about trader intent.
Precisely. These flows are key to figuring out what traders are planning or how nervous they are. For instance, if traders are genuinely fleeing risk, they'll likely sell their crypto holdings, BTC, ETH, altcoins, and convert them into stablecoins. In that case, the supply of stablecoins held on exchanges will probably rise. That signals traders are taking a time out, parking funds in digital dollars, maybe waiting for clarity.
Okay, what if they leave the ecosystem entirely?
Right. If they convert those stablecoins back into traditional fiat currency, like US dollars in a bank account, and withdraw it completely off exchange, that's a stronger signal of acute panic or just complete risk aversion. Abandonment? Maybe. But if the total stablecoin market cap trend holds relatively steady, or maybe even slightly rises on exchanges, that suggests money is staying in the crypto ecosystem. It implies capital is waiting, ready to be deployed back into assets like Bitcoin or Ethereum the moment the political gridlock breaks or sentiment shifts. It's dry powder.
Got it. Okay, dominance, ETH, DeFi, TVL, stablecoin flows. What about sentiment? How do we gauge what the smart money is doing versus maybe the retail crowd?
Yeah, we need to look at on-chain sentiment and specifically whale activity.
Whales, we
Yeah.
define those as.
Usually defined as those large wallet addresses holding a significant amount of Bitcoin, typically 1,000 BTC or more. Now, these sophisticated entities, these whales, they often view political dips, macro uncertainty, periods of fear. They see them as prime discount opportunities. They tend to be accumulators during panic, not panic sellers themselves.
So tracking their movements gives us insight into.
It gives you potentially deep insight into institutional or smart money accumulation versus maybe more reactive retail panic. If you see the number of wallets holding 1,000 plus BTC actually increasing during the shutdown, despite all the negative headlines and price dips, that can be a strong bullish divergence signal. It suggests that powerful capital believes the long-term hedge benefit we discussed outweighs the short-term noise and risk. They're buying the fear.
And for the other side, for retail sentiment.
For retail sentiment, a common tool is the Crypto Fear and Greed Index. You know, the one that measures the prevailing emotion in the market, from extreme fear to extreme greed. During a shutdown, you'd typically expect the market, and therefore the index, to dip sharply into fear, or even extreme fear. That's normal. The key is watching for that divergence we just mentioned. Retail panic, indicated by a high fear index reading, happening at the same time as increased whale accumulation, a growing number of large wallets. That combination, retail selling, whales dying, often precedes a strong rally once the underlying political issue, like the shutdown, gets resolved.
Okay, that makes sense. One last indicator. You mentioned macro correlation.
Yes, finally, we absolutely must emphasize tracking the macro correlation, specifically between BTC USD and the DXY.
The DXY being the dollar index.
Correct. The US dollar index, which measures the value of the dollar against a basket of 6 major world currencies, euro, yen, pound, etc. Historically, these two assets, Bitcoin and the DXY, have often displayed a pretty strong inverse correlation, meaning when the dollar weakens, Bitcoin often rallies and vice versa. Not always, but often.
So during a shutdown, what are we looking for?
Well, if the shutdown really drags on, and if it genuinely starts to erode global trust in U.S. fiscal management, as we discussed, then the DXY is highly likely to weaken. Foreign investors might sell dollars or dollar-denominated assets. Tracking that inverse relationship in real time is paramount. Is Bitcoin rallying as the DXY falls? That would be strong confirmation that the digital gold or dollar alternative thesis is actively playing out. If, however, both Bitcoin and the DXY are falling, it might suggest the crisis is perceived as so severe that it's forcing a flight to global safety outside the U.S., maybe to other traditional fiat currencies, or just extreme risk-off across all assets. So the strength or weakness of that BTC-DXY inverse correlation is probably the primary real-time indicator of whether we're seeing a shift toward a non-sovereign hedge or just broad market panic.
Wow. Okay. So we've really covered the entire spectrum here, haven't we? From the immediate operational freeze to the deep macro and geopolitical shifts. And core tension remains. The paralysis in Washington creates this intense short-term market friction, the regulatory slowdown, the data confusion, the potential for delayed rate cuts. But simultaneously, it serves as this powerful, fundamental, long-term catalyst for the whole decentralized thesis. It just keeps proving that centralized systems are often unreliable and, frankly, prone to chronic failure.
And that really is the absolute core takeaway for you, the listener, right now. This chronic failure of government to function effectively, whether we're talking about these repeated debt ceiling crises or these shutdowns, it just makes the inherent stability of decentralized math and code look incredibly attractive by comparison. It becomes a true, fundamental hedge against fiscal and political instability. Our sources, the historical data, the market reactions, they are pretty definitive on this point. Instability in DC acts as a structural tailwind for Bitcoin's core value proposition.
Okay, so to wrap up, let's leave you with one final provocative thought. This builds directly on the projections in the source material we analyzed.
Given that U.S. economic weakness could potentially deepen, maybe due to these chronic political failures becoming more frequent or severe, and given that Bitcoin's appeal as a safe haven asset seems to rise in response to that weakness, how might a future political crisis, perhaps one even more severe than this shutdown, interact with the already potentially bullish signals we might see post the 2025 halving cycle? Think about that combination.
Yeah, what is your strategy right now listening to this? Are you thinking you hold Bitcoin through the noise and wait? Are you maybe buying stable coins, sitting on the digital sidelines? Or do you move entirely into traditional cash and just wait for all this dust to settle, something to really mull over? And hey, if you found this detailed breakdown valuable, and we really hope you did, we put a lot into unpacking those sources. We genuinely encourage you to support the channel. Subscribing, hitting the like button, dropping a comment below with your thoughts, maybe sharing the video. It really helps us support the show. Honestly, it boosts our visibility in the algorithm, lets the platforms know you appreciate this kind of content, and that allows us to keep bringing you these deep quality analyses, connecting the dots between politics, macro events, and how they actually affect the crypto markets you care about. We really thrive on your engagement, so please let us know your thoughts on this whole thesis below. We'll see you on the next deep dive.